thought it was on. Good morning, good afternoon, or good evening, everyone who's watching and joining our webcast on the new Brazilian withholding tax on dividends. It's a pleasure for me to have my partners and friends here join me. Doug McConey, our global leader of ITS, Arne Schnittger, our German ITS partner, representing not only the German potential effects of this new rule, but also bringing us an EU perspective, and Shintaro Yamaguchi from our Japanese practice also to share his insights on what might happen to a treaty partner. We will jump right in, again, with a round of thanks to my fellow colleagues and panelists and partners here, with a quick description of this new rule, and with the reason for us calling this webcast, if you will, as a breaking news kind of event out of our usual cross-border tax talks, Doug, where we discuss things in a little bit more depth. But this one here requires some year-end action from our clients. This is the main reason why we've called this with relative urgency and trying to cover the whole world, the whole globe with Doug, and as well as Europe and Japan with Arne and Shin. But basically, Brazil has indeed introduced, we have been highlighting this for a few years now. There have been several projects where a potential reintroduction of the dividend withholding tax was contemplated. But in prior projects, there was a more, if you will, a clearer cut in terms of whether historical earnings would be subject to tax, whether there would be a cleaner transition rule, or whether there would be a reduction of the corporate tax rate. And what's actually happening is, if you will, a worst case scenario type situation where we are maintaining our corporate tax rates, which are already amongst the highest, if not the highest in the world. The general corporate tax rate at 34%, the financial services sector with nominal rates at 40 or 45. The local revenue authority estimates effective tax rates in this general if you will, general taxpayer basket at 22% ETR, and in the financial services basket at over 30%. So we're now introducing a 10% dividend withholding tax on top of the existing corporate taxes. And this new rule kicks in as from January 2026, but it does not have a safeguard per se for profits earned through December 31st, 2025. The only transition rule that it brings is that if profits, if dividends are authorized for declaration, this is an important term for us. It's, if you will, it's one step softer, one step before an actual declaration, but it has to fit within the framework of the articles of incorporation of the company, the bylaws, the corporate or civil law governing the legal entity, which varies tremendously. But the least taxpayers have to do is to authorize the declaration of dividends. For most legal entities, most bylaws, and most existing situations, you will actually need to declare dividends from a practical point of view. And then there is a transition rule, if you will, that not only those dividends have to be declared, but by analogy, with what happens to domestic taxpayers, we are of the position that they have to be paid out within 3 years, so by 2028, right? A lot of investors, inbound investors in Brazil, have financed, their local balance sheets also with retained earnings, also because historically we've had and we still have interest on equity. So to the extent that we're wiping out retained earnings and declaring dividends, that base will be reduced going forward. A lot of companies did not have or do not have cash at hand to pay those dividends out, so they might need financing to actually make sure that those dividends that are declared get paid out. And again, given just the high combined aggregate rate that we end up having with the corporate tax rates, the level that they are, with this additional 10% on top, and with Brazil's treaties, and this is one of the reasons why we also have Shin here with us, with Brazil's treaty not limiting withholding taxes below 10%. The newest treaties we have are at 10%. Historically, the Japanese treaty was, the best one, it was 12.5%. It still is. And a lot of our treaties allow a 15% rate. So the treaties will not be of any help. So we end up really having with this very high effective tax rate on fully repatriated earnings, which again calls for reflection, calls for action in terms of how the local operations are funded, how they're supposed to continue funded or going to be funded going forward. And again, what's the overall strategy with respect to Brazil, given that now Brazil is really not just in consumption taxes, but now also on business profits, really becoming a global outlier in terms of effective tax rates and being a high tax country. So with that quick intro, I wanted to ask Doug to give us some perspective, some high level perspective here first, in terms of what does this mean from a global point of view. So thinking of taxpayers from different parts of the world, treaty country, non-treaty country, credit countries, participation exemption countries. What is your view, Doug? How can this affect multinationals, what Brazil is doing right now? And again, thanks for being here.
Thank you very much for having me, Ramiro, and good afternoon, good evening, and good morning. So maybe I'll start, Ramiro, from a global perspective, and certainly look forward to hearing to Arne's perspective from a German and European perspective, and of course Shin's from a Asia and Japanese perspective, and then I'll turn to the U.S. And really put my U.S. hat on. I think that the broad view from a global perspective is that this additional withholding tax is going to be an absolute cost for taxpayers. Obviously, some systems like the U.S. that have a foreign tax credit system, which I'll explain more, given the high tax nature of Brazil for the reasons that you described, I mean that this is going to be an additional cost. For those taxpayers that have a participation exemption, or for those countries that have a participation exemption, that do not have a foreign tax credit system, this is an absolute cost. And so I think the big picture message for taxpayers is that this new tax simply adds to the amount of taxes that inbound investors into Brazil need to pay, and will reduce the ROI for inbound investment into Brazil. And Brazil obviously has one of the most complex tax systems in the world. Ramiro, we've talked about that on the Cross Border Tax Talks podcast. Variety of layers of tax, and this just adds an additional layer to that tax. And so the advice that I would give to taxpayers from any jurisdiction is as you are contemplating an investment into Brazil or looking at the return on an existing investment, that generally speaking, this withholding tax is going to be an absolute cost, an additional cost, and reduce that ROI. Now, maybe I'll turn to the U.S. tax system and maybe just remind folks kind of the framework of the U.S. tax system. I was going to say it changed relatively recently, but I'm reflecting my age now. It was really during the first Trump administration, during the Tax Cuts and Jobs Act, that we really had a fundamental change to the U.S. corporate tax system. The 35% corporate rate was reduced to 21%. The historic way that earnings were taxed before the TCJA, so before that act in 2017, foreign earnings were generally deferred from U.S. tax until they were repatriated. We, of course, have this provision called Subpart F, that certain types of earnings that were earned offshore, whether it's low tax financing income or buy-sell type structures in a low tax jurisdiction, could be immediately subject to that U.S. tax system, or so it can be immediately subject to U.S. tax under that system. With the enactment of the Tax Cuts and Jobs Act, it really was a fundamental change that I think most inbound and outbound investors are now relatively accustomed to. Obviously, our corporate rate was reduced from 35% to 21%, and it also introduced GILTI, so our global intangible low taxed income, which has now been renamed our net CFC tested income, which I think many of us refer to as necktie. But generally, that was the first income inclusion rule that we've seen in the world. And the way the GILTI system works is that all income from CFC LLCs, subject to a couple of exceptions, is immediately subject to U.S. tax. That rate was 12%, but as a result of the most recent Trump tax reform, the One Big Beautiful Bill Act, or commonly referred to as OB3, the amount of tax that U.S. shareholders pay on their GILTI income is now roughly 14%, including the foreign tax credit. Now, one of the many things that makes the U.S. tax system unique is our complex foreign tax credit system, so that U.S. corporate investors that are investing in Brazil or investing in other foreign jurisdictions that are treated as corporations for U.S. taxpayers generally get a credit for those foreign income taxes that are paid, both direct corporate income taxes as well as withholding taxes, to reduce the GILTI income. I'll talk a little bit about individual investors, because that system is certainly different than corporations. While U.S. corporations generally can take what used to be referred to as an indirect credit, so in other words, the foreign taxes that are paid by foreign corporations, individual investors generally do not get a foreign tax credit for investments that they have in corporations. Consequently, many individual investors or individual investors that invest through funds or similar type of investment vehicles would elect to treat the Brazilian corporation or foreign corporation as a pass-through entity for U.S. tax purposes under our check-the-box rules, because U.S. individuals are allowed a direct foreign tax credit. So to the extent that they operate through a branch or a check-the-box branch, those taxes that are paid by those in those foreign jurisdictions for individuals are subject to direct foreign tax credits. Now, regardless of whether it's individuals or corporations, because the U.S. corporate rate is 21%, because the GILTI rate is 14%, individual investors, their rates can be significantly higher. But generally speaking, for those investments that whether it's individual investors or corporate investors have in Brazil, they are maxed out from a foreign tax credit perspective. So said another way, these additional withholding taxes that will be imposed on distributions that are coming out of Brazil will be an absolute cost, or will likely be an absolute cost for those inbound investments into Brazil. The OB3, the One Big Beautiful Bill Act, did make some big changes, certainly created certainty for both inbound investment into the U.S. as well as for U.S. taxpayers that are investing into Brazil. As I mentioned earlier, the GILTI rate increased from roughly 12.5% to 14%. It eliminated some of the complexities and limitations associated with being able to take a foreign tax credit, including expense apportionment that would generally require U.S. multinationals to reduce the amount of foreign tax credits that they could take on outbound investments. But despite the fact that the GILTI rate moved from 12.5 to roughly 14, and the elimination of interest expense apportionment, because the rate of tax is so high in Brazil, most U.S. taxpayers are in an excess credit position. In other words, they already have more foreign tax credits than they are able to use. Many people are now aware, particularly with all the noise that we're seeing on the side-by-side agreement, that the U.S. GILTI system is a blended system, unlike Pillar 2, which is based on a jurisdictional matter. But for the most part, most U.S. taxpayers are in an excess GILTI position. As we look around the world and we think about the implementation of QDMTTs, along with all the other corporate income taxes, most U.S. taxpayers are in an excess GILTI foreign tax credit position. And the GILTI foreign tax credits, unlike the other foreign tax credits in the U.S., do not carry over. So this additional 10% withholding tax, again, is a absolute cost for most U.S. taxpayers, both corporations as well as individuals. Now, one of the things that I also should mention is that the U.S. does have what is referred to as a high tax exception for GILTI. And so to the extent that earnings earned by a U.S. corporation are not subject to GILTI, they are potentially subject to what we refer to as our Section 245 Cap A, which is effectively the equivalent of our participation exemption. One of the things that U.S. taxpayers can elect to do is, if income is subject to tax in a foreign corporation of at least 90% of the U.S. corporate rate, so roughly almost 19%, U.S. taxpayers can make a GILTI high tax exception election. That means that those future distributions from a controlled foreign corporation where a taxpayer has made the high tax exception would be subject to our participation exemption under 245 Cap A. Now, many taxpayers historically have taken the high tax exception for Brazil and other high tax jurisdictions. But it is very important to note that Brazil also offers, as Romero mentioned, the interest on equity. And the interest on equity, depending on how your structure is set up, can create a hybrid deduction account. And what that hybrid deduction account means, without going too deep into the U.S. tax technical rules, Romero, what that high tax exception or what that hybrid deduction account can result in if a taxpayer is taking the high tax exception for GILTI and they're taking an interest on that equity, is that those future distributions from that Brazilian entity, if there has been an interest on that equity, those are not subject or can be the Section 245 Cap A, that participation exemption, can effectively be denied if there is a hybrid deduction account. Now, some of that can be managed through check the box elections, depending on how Brazil is structured. But either way, just to be mindful that, again, the message is that 10% dividend withholding tax is generally going to be an absolute cost. And to the extent that you are otherwise taking the high tax exception election, planning to take 245 Cap A, if there is an interest on that equity, that income that is distributed that would otherwise be subject to Section 245 Cap A is denied. The foreign tax credits associated with that are also denied. And so I think we're going to talk about a little bit later in the webcast, Romero, what are some of the structuring and planning things that taxpayers could consider, including accelerating dividend distributions out of Brazil, because again, this could be an absolute cost for those taxpayers.
That's exactly right, Doug, and thanks for this. Let me unpack that a little bit. We do expect to have viewers here from all over the world, and what becomes evident to those who are not as close or not as familiar with the U.S. system as many of us are, is that, again, the U.S. system is the most sophisticated and complex income tax system in the world by long distance. But the point here that I wanted to highlight, just to give perspective to our viewers, is that Brazil has an inbound stock of FDI of roughly $1.3 trillion. No less than $360 billion of that $1.3 trillion is US FDI. And if this hurts US FDI into Brazil, it hurts Brazil considerably. If that reduction in ROI that you have mentioned, Doug, because even though it's a credit system, we're going to be dealing with excess credits, especially post OB3, where corporates will be operating on a blended lower effective tax rate. We end up really having Brazil be the ugly duckling here, or the ugly duck, if you will, in terms of standing out as a high tax jurisdiction with a sunk cost. One technical point here also to highlight is in the fund structure, you have mentioned some of the flow-through structures. It is very common for our financial services clients and for taxpayers coming in from the US and all over the world to structure their investments into Brazil, portfolio investments, but even direct investments that are held through US and Luxembourg, etc. funds, through also a Brazilian fund called the FIP. And FIPs are a domestic recipient of those dividends that are not caught by this 10% withholding tax. The trade-off there, and we're going to talk about planning a little bit later, is that the computation of capital gains is different, and it's worse for funds than it is for direct investments from a corporate. But the vast majority of FDI coming in from the US comes from corporate groups, from publicly traded companies and so forth, that will have individual shareholders on top, subject to the classical US double tax on their personal dividends that they collect from the ultimate US parent. So this additional Brazilian cost, this sunk Brazilian cost, which is not used by the US corporate parent, will also not be used by the ultimate individual shareholders coming in from the US, different from perhaps some systems that will flow everything up or integrate the entire business profits burden at the individual level. So we are dealing with really a problem for a credit, a notorious credit jurisdiction, which is not a pure credit jurisdiction, as Doug has mentioned, since the first Trump government, but to a notorious credit worldwide tax credit jurisdiction with a blended approach, but still we're dealing with a tax hike. We're dealing with a problem we're dealing with a reduction of ROI for US investors into Brazil, absent planning. If we flip from that to our second largest investor into Brazil, which is, I'm going to use Europe as the bigger picture here, because again, economically speaking, this is how Europe, the European Union works, and this is how a lot of the trade that happens between Brazil and Europe is, if you will, a block trade. So Europe will be, I mean, it is by region, it is the largest investor into Brazil. We end up having, again, because some US companies use European holding structures, but by a long shot, Europe, the aggregate European Union, EEA region, is the largest immediate direct investor into Brazil. And again, but we did have a treaty with Germany. That treaty was denounced, terminated by Germany with reason, because of Brazil's position on technical services, transfer pricing back then. So it is already a history of difficult reconciliation of the Brazilian tax system with the German tax system and with the system applied by European investors in general. But I wanted to use the example of Germany that currently does not have a treaty and that has a form of participation exemption under domestic law to get honest insights into how this might translate, how this Brazilian 10% withholding tax on dividends might impact German multinationals investing into Brazil, or more broadly, European investors investing into Brazil, and how does that compare with the European investors investing within Europe or within the OECD world, in the US and Japan, for example.
Yes. Well, thank you so much, first of all, having me here. Very glad to join on this topic. And I will talk about today, of course, the view from a continental European perspective, and I'll basically make Germany as an example and dive a little bit deeper, even though I think a lot of those principles apply for other territories as well. You rightfully said we don't have a treaty, so therefore any kind of increase of withholding tax directly hits us as well. And I can also only say the topic of sunken costs is also applicable in our case. Maybe let me just, get a little bit into details how the German system works. And this is also very much based, by the way, on European law, Parent Subsidy Directive. So in general, we have an exemption system foreseen. That means dividends being received, basically, generally kind of exempt. There are certain thresholds which needs to be met. And in a German particular kind of view, you need to also be mindful that we have actually two systems, which is one, the corporate income tax rate, which is currently at 15%, which will be reduced over the next kind of years down to 10%. And we have a trade tax, which depends on each municipality, but roughly it's also 15%. So you can see trade tax is also an important tax, and actually with the reduction of corporate tax, it actually becomes even more important. And the withholding taxes are also the question, how do you basically apply for those two rates? And there it's important because for the corporate and tax perspective, in principle, we can credit the taxes if we don't have an exemption. We'll come to this in a minute. But for the trade tax, we don't even have the possibility to credit any kind of withholding tax because the trade tax is a pure system based on territoriality. So there are some court cases who are basically trying to argue that this is not in line with higher taxing principles, put it like that, that there might be also, might be a problem under treaties, basically, because this is a problem which is also applicable under treaties where we have a lot of times the requirement to credit taxes, and we don't do this under domestic law. Now, this doesn't help, obviously, in the Brazilian context, as you noted, Romero, we don't have a treaty anymore. So the sunken cost in the trade tax scenario is for sure the case. And there, this applies especially, and it becomes really a problem if you don't fulfill the participation requirements, which under German corporate income tax law is 10%, and the trade tax is 50%. So everything below, just to reiterate, you pay on the dividends, trade tax, and corporate income tax. You'll be able to credit the corporate on the corporate income tax, the withholding tax. So that's kind of giving a little bit of a relief. But the trade tax remain at the 50% I just mentioned. If you fulfill the requirement, which for most cases is the actual situation that you have 100% shareholding and you have 100% exemption, you still need to be mindful we have a 5% deemed add back for business expenses, even though you don't have any business expense, which brings it to a 5% income inclusion with a 30% rate, which is corporate income tax rate 15% for trade tax, makes it 1.5 tax, very roughly, kind of rough, back in the envelope kind of math. And on this, because the question then will come also up, well, can you at least credit the withholding tax presuming one on this 1.5 tax? And the answer is also no, because it's a tax on the expenses, on the non-deductible expenses, and we can only credit it to the income. And it's a very technical argument to what extent this is correct or not, because the 5% is in fact calculated on the dividend income. But it leads to the fact that still, in this case, there is not a credit on the 5% as well. So therefore, I think it's fair to basically come to the conclusion that definitely will make investments into Brazil less attractive. We will probably talk a little bit any kind of end of the year requirements, what we can do in order to at least safeguard profits for the past. I think we'll come to this in a minute. And in the future, it's just basically it becomes a little bit less beneficial in order to invest into Brazil. And Romero, I think that goes back to you then.
Thanks for this, Arne. And again, this is a very, very interesting point also on the mechanics and the application of the 5% inclusion, because again, from an investee, from a Brazilian perspective, to the extent Brazil needs to declare dividends or to pay out dividends in order to escape the application of the new withholding tax to historical earnings, you're also triggering that 1.5%, which you would not necessarily trigger if it wasn't for this urgency, this timing, this need to wipe out retained earnings, to reduce this inefficiency of the 10%, the sunk cost of the 10%. So you either have a cost of the 10% or a cost of the 1.5%, where both are new factors burdening German investment into Brazil because of the Brazilian new rule. And Arne, just a couple of follow-up questions and comments from you. And this is, again, just also to help the fact that we might have viewers here who are watching our webcast from Brazil or from Brasilia. But similar to the US, again, I've mentioned that US individual shareholders in US publicly traded or closed corporations that are not flow through, they will be subject to their personal tax on their dividend income that they receive from the ultimate parent. In the case of the US, ordinary income, if I'm not mistaken, there is a special progressive rate regime, etc. But in the case of Germany, correct me if I'm wrong, and this might be common in Europe, there's a withholding tax that applies to dividends from the ultimate parent, the German ultimate parent to the German shareholder, which has absolutely nothing to do with this sunk cost. So the Brazilian withholding tax, which is not used by the corporate parent, will also not be used by the ultimate shareholder. So it becomes a true cost throughout the chain. And just reminding the viewers here of that, and the fact that how would it compare if you have a German shareholder investing in a German firm and in the French market or within the European Union or in the US and in Japan? What kind of withholding and how does that flow if it goes back to Germany?
Yeah, Romero, thanks for actually bringing this up. That's also an important point. So first, to confirm what you just said is absolutely true. So our system is really only working on each level, which I believe in other territories in the US it's different, where you have a broader kind of approach. For us, we look at each level, and as you stated correctly by you, any kind of Brazilian withholding tax is really stranded kind of credits. So they will not be transferred over to the individual shareholder. So that means you will have a return which is lower after tax at the parent, at the German parent level, and then you apply, we have a 25% rate on the distribution. So it's going to be really basically eating in your profits and your ROI. In comparison to your question, what happens if you invest into other territories? In most cases, we have treaties. In a lot of cases, we have them reduced to 0%. The US, for example, has under certain conditions where we have certain threshold requirements where the 100% is met, and then there are some requirements in the LOB clause, but you can get to 0%. And the new treaty with Japan also has actually similar, circumstances. And in the European Union, we have the parent subsidiary directive. So to your question to France, it's going to give you a 0% rate as well. So the 0% is something which we're getting used to right now. And now there's a bit of deviation if it comes to investments into Brazil.
Very helpful. Thank you, Arne. And again, this is to educate our Brazilian viewers and hoping that this will also help nudge the debate of broader Brazilian corporate tax reform, at least to approximate Brazil with jurisdictions around the world that are not known to be particularly friendly. So if we were to mimic, copy and paste the German or the Japanese tax system into Brazil, Brazil would become incredibly more competitive than it is now. And just with that, transposing a little bit to Japan. Japan is Brazil's most, let's say, reliable, long-standing treaty partner. The level of cooperation between the Brazilian tax authority and the Japanese tax authorities, even when Brazil was not necessarily as responsive in mutual agreement procedures, etc., it has always had a strong and a cooperative relationship with Japan. The Japanese treaty is the one that Brazil has with, for instance, capital gains only tax at the residence, with reduced withholding tax rates in comparison to the other treaties. So it is one of the most trusted foreign investors into Brazil, which has interests both in wholly owned, controlled subsidiaries here, as well as in many, many traditional Brazilian publicly traded companies with significant shareholding. For some of the Japanese trading houses, for example, have significant shareholdings in the Brazilian mining sector, in paper and pulp, cellulose. There's all kinds of sectors that historically the Japanese have invested in for the long term. And again, the fact that we do have a treaty during the congressional debate here was used by the Brazilian tax authority to say, well, there's a treaty, so there would be no double tax. This is not a problem for a country with a tax treaty with Brazil. The 10% will either be creditable or will be otherwise neutral to the investor. And I wanted to pick Japan as the case and the example to demonstrate again with Shin that no, this is not the case. But I wanted to hear it from Shin. How would a Japanese inbound investor into Brazil be affected by this new withholding tax of 10%, Shin? And again, thanks for joining us today.
Thanks, Romero. Appreciate your having me on today's webinar. So as you mentioned, Japan does have a treaty with Brazil, and I think long-standing would be a good characterization. The treaty itself dates back to the 1960s, and as you also mentioned at the outset, it does have a provision in the dividends article that says that each country can apply a dividend withholding tax of up to 12.5%. So as I understand it, to the extent that the contemplated dividend withholding tax on Brazil is 10%, that would be within the parameters of the Brazil-Japan treaty. How does that get treated then on the Japan side when there is a dividend paid up? For example, speaking on the general rule, we do have a foreign dividend exemption system whereby if a Japanese company owns more 25% or more of a foreign company for 6 months, generally speaking, dividends from such foreign companies are exempt. 95% of such dividends are exempted, and so in effect, you recognize only 5% of such dividend as taxable income here in Japan. On the flip side, to the extent that this foreign dividend exemption rule applies, there is the foreign tax credit is not available in Japan. So if a Japanese parent company were to receive a dividend from its local subsidiary in Brazil, it would be on one hand, as mentioned, it could apply the 95% foreign dividend exemption system, recognize 5% of tax, but to the extent that there is a 10% withholding tax at Brazil, then that could not be creditable. So it goes back to what Doug was alluding to in his comments, where essentially the 10% Brazil dividend withholding tax could be treated, could have the effect of a tax cost.
This is as expected and unfortunate, Sheen, but it's important for us to again build knowledge around the debate here, which continues. There is the expectation that, again, this new tax was introduced in a bill that was supposed to be about individual personal income taxation in Brazil, and it does have several provisions about individuals. It establishes the 10% as a minimum tax on high earners. It's like a Pillar 3 type situation that we're trying to experiment with under the Zuckman type of tax on wealth. And it also provides an exemption on low income. So it was supposed to be about a personal income tax, not even a reform, but a change in the personal income tax. And it became a matter which is incredibly relevant for corporates, for inbound investors, and again, to our most traditional investor, our most relevant continent investing in Brazil, and the largest FDI investor, which is the US.
All right, Romero, so maybe we can turn now to what are some of the proactive things that taxpayers may consider in anticipation of this rule. And I'm going to go to, we've already received a number of questions. We welcome people to bring in questions, but maybe let me start, Romero. I'll turn the tables here a bit to ask you a couple of questions. Can you share with the participants what it means to make a dividend or declare a dividend before the December 31st timeline, and maybe a couple of sub questions to that. First of all, does the distribution actually need to be paid? Does it need to be declared? That is one of the specific questions. And then, does the distribution actually need to be in cash? Could a taxpayer potentially distribute out a note, for example, or could the taxpayer otherwise borrow locally from a third party, for example, to make that distribution? So in other words, what are some of the practical things that taxpayers should consider if they're trying to beat the deadline, so to speak, with this December 31st enactment date?
All very good questions, Doug, as always, and thanks for that. But again, the law, when it was originally proposed, had absolutely no transition rule. It was attempting to really retroactively, in our view, reach any and all earnings. And again, this would give rise to substantial litigation here. And during the congressional debate, after the original bill was presented without any transition rule, there was, again, massive back and forth in terms of how the law could be amended for a transition rule to be made available, and how would that transition rule be like. So the wording of the rule, because it was done at the congressional floor, is poor. It's not very well written. And that causes a lot of confusion. That we're seeing, for instance, local banks and a lot of local, even good local law firms, taking the view that the dividends have to be declared and paid, before December 31st. There's a lot of practical issues and practical implications with that might render it not feasible from a number of different angles. But that, in our view, is a misinterpretation, is a poor reading of the law. Even if the law is poorly written, this is an even poorer reading, in our view, of what's written there, which has to be, in our position, interpreted systemically. So there's a system there, there's a legislative history around it, and there's language that if you read the whole law from beginning to end, you can actually see that what's provided for there is that the declaration or dividends or the earnings, there has to be an authorization by shareholders for dividends to be paid, credited, employed, remitted. When we say credited, that means payable. If a dividend is declared, it's necessarily a payable. If you're authorizing a later credit, that means you're authorizing a later declaration. So in our view, the least, or let's say the most aggressive position that a taxpayer can take is to say, here's a shareholder's resolution authorizing a declaration of dividends, so earmarking out of retained earnings what will be paid out as dividends within a given time frame. We also take the view that the time frame that applies to domestic dividend receivers, recipients of dividends, which is they remain exempt from the 10% minimum tax if they're paid by 28. We're taking the position that this is the same tax, this is systemically the same law about the same thing that is applying to non-residents, with the presumption that non-residents are treated as high earners. So with that, the 28 limitation also applies. So that authorization, which is, the minimum standard is the authorization for dividends to be declared and paid by or before December 2028. Again, given that this is Brazil, litigation here is lengthy, is costly, is uncertain, vis-a-vis, our West Coast clients having been on the news recently. But we are taking the position that instead of a mere authorization, the ideal or the most recommendable position is that you declare the dividends. You don't necessarily need to pay them out. There's this position also that if you declare them, you have to pay them out. You have to look at what the bylaw says. It depends on the form of the corporate entity. If you have minorities, for example, if it's a publicly traded firm, so you could have all kinds of consequences from declaring, which have to be addressed and dealt with. You might have to work with a shorter framework of time frame for the actual payment to happen, 60 days, a quarter, for example. But that's the exception. For most investors that we have doing business in Brazil, they use limitadas, they use closed companies, privately held. And for a limitada, the declaration does not have to be followed by a specific date of payment unless provided for in the articles of incorporation or in the shareholders' resolution. So we could have a limitada declare and really only pay by or before 28 and still be fine. So the cash impact of this, and I see even in the panel here some questions coming from our local tax directors here concerned about whether they do have to pay it out. To the extent that you do not pay it out, then two issues come in. If you're gonna, you don't have the cash. So to your question, can you borrow to fund a dividend? So there's a hypothetical question here, which is, would that interest be deductible? Is it a necessary expense for business profits? We take the position that it should be. So to the extent that you're refinancing, you're looking at your balance sheet, you're refinancing with external debt which is local, incredibly expensive, so not recommendable from a treasury point of view. But if that's what you do, if that's what you have, fully deductible. If you're talking about a cross-border loan, then our think cap rules kick in, transfer pricing kicks in, but that's the analysis. The first part of the analysis here is what is now your optimum capital structure for Brazil, not only given the dividend declaration, but your paid-in capital. Will you continue to have the same amount of paid-in capital in comparison to intercompany debt, or do you want to, or should you revisit your debt to equity position? I assume that you might have other questions, Doug.
Yeah, so maybe that I think that's very helpful and good context for what actions taxpayers may need to be able to take before December 31st. Once we move past into this new regime, past that December 31st, what are some other mechanisms the taxpayers could consider? So maybe two parts to this are capital reductions, so that we see in other countries that where instead of declaring a dividend of retained earnings, you may be able to reduce capital in the entity to so that it actually isn't a dividend, it's a return of capital. The second thing that we see sometimes in other jurisdictions is the ability to be able to lend money up to the shareholder as opposed to actually making a distribution. Now, obviously, the lending of money, to your point, has transfer pricing considerations, withholding tax considerations. I should have mentioned earlier that the U.S. does not have a treaty with Brazil. So if money was lent to the U.S., we need to think about potential 30% withholding taxes. But generally, are capital reductions potentially available for Brazilian entities? And what about the idea, instead of declaring a dividend, lending that money, whether it's to a shareholder or another group company?
Doug, I mean, all key questions that every taxpayer needs to think through now. But yes, we have, and again, it will depend on the form of the corporate entity to figure out what exactly is the format of the capital reduction or redemption of shares, etc. Whether you have minorities, whether it's a publicly traded local entity. Sometimes our FDI clients, our multinational clients, do have local JVs or local publicly traded companies. But again, for the most part, we're talking about limitadas, privately held, closely held companies, where you can effectively revisit your capital structure and do a capital reduction and refigure how much debt to equity the company needs to have. We do have playing a role in this whole setup a non-income tax, which is a financial transactions tax, IOF, which has just been increased to 3.5% for most cross-border payments out of Brazil, which can be a transactional cost, depending on how you refinance and how you fund. From a GAR perspective, it would be important to evaluate whether you want cash flowing in and out, depending on who the parties will be, where the money is coming from, where the cash is going to, so that in the end you don't have a structure which really only changes on paper. So to the extent that you do go through the exercise of substance, the exercise of pricing, and you figure out that the company should have more leverage, should have less equity, yes, capital reductions, capital redemptions, in addition to dividend declarations, play a role. I'm curious also, to think about how all of this plays out with the sample of jurisdictions that we have here on the call. So if I'm talking, from with a U.S. multinational hat on, with check the box, all kinds of things that you can do to either regard or disregard a note or the loan, etc. It might be, I'm guessing here, it might be easier to make that decision in terms of to what extent you have debt or equity into Brazil. You may end up not having a regarded loan and end up having the same amount of business profits flowing up either into the U.S. or to a holding company, whatever. But for our Japanese and our German colleagues here, and for, let's say, European inbounds into Brazil, the decision might not be as easy. Without check the box and without disregarding loans, you may end up with either a CFC pickup or with a taxable interest, which doesn't necessarily make sense. So I just wanted to hear a little bit from Arne and Shin about these refinancing exercises that we will need to do from a Brazilian perspective. How can that work or not work? What are some of the pros and cons from a German or from a Japanese perspective?
Yeah, Romero, if I just basically pick this up, we will have to see. I mean, I guess really it's going to be first a little bit the question, to what extent can we basically bring back capital before year end? So I would expect that's going to be something people will have a look quite a bit, basically. Other than that, any kind of ideas, bring back cash by upstream loans. You've touched on CFC rules, of course. We have a 50% corporate income tax rate. So therefore, I would assume that hopefully in most cases we'll get around that. But also if you have upstream loans, which are quite long and quite lengthy, and there's no real kind of intention to pay it back, you might actually be ending up in a situation that you have at least also a dividend from a German perspective, which we'll see. And it's going to be interesting to what extent you have a similar concept. I believe the US has it as well. If there's a long loan kind of, and you don't really believe that this is something which will ever going to be paid back, or the company has a possibility to pay it back, or the intention, you have those workaround rules in order to have a deemed dividend distribution. It's going to be interesting also to what extent we're going to see some further potential planning, basically, in terms of to what extent can you relocate basically an entity from Brazil to somewhere else. But of course, then we have to talk about the capital gains tax, which I understand have not really changed. But Romero, happy to talk about this as well. I think you have a direct capital gains tax, which in a non-treaty scenario is to be observed. The indirect tax, I believe, it's still not there. But it could be a challenge for those cases where you don't have a treaty then to move also, from one structure to another one. But Romero, maybe you can help us a little bit there, to what extent there is a possibility to change the structure.
Yeah, I mean, there definitely is. Before I pass it to Shin to hear from him on refinancing, how complicated, trivial pros and cons from a Japanese perspective. On the capital gains tax, indeed, our rules have not changed. And those rules have not changed in the same way that our corporate restructuring rules have also not changed. So the challenge there would be, can we have a transaction that can fit into a carryover basis, non-taxable event situation where the capital gains tax does not apply? Or do we have outside basis from a Brazilian perspective, which may differ from the outside basis from a German perspective, such that even if there's a capital gain, maybe there's no gain, or there's a small gain to be taxed? So these are all very important questions that, again, thinking of German investors, we would need to go through to figure out whether the refinancing can work, as it probably does for U.S. multinationals with the, from a U.S. tax perspective, have all these different tools to use to make it work. But again, from a Japanese perspective, Shin, would the analysis be similar to the German analysis, or would it be different?
Thanks, Romero. Yeah, let me I think echo Arnie in the sense that when we're thinking about refinancing or other options, we do not have a check the box regime or something akin to it. So we would have to provide some further thought as to what our options might be. We also have Japanese CFC rules which trigger around tax rates and effective tax rates, and also substance requirements. But that would be one area to consider. But bigger picture, what potential options we may have, we have to kind of think about it, given this is a relatively new development, and we're just beginning to discuss this matter with our clients here in Tokyo.
Yeah, very clear. I mean, one point there. Go ahead, Doug. Sorry, go ahead.
Oh no, go ahead if you just want to make that point, and then I was going to change gears.
Sure. I mean, just one segue to this discussion on financing and refinancing. What we're seeing and what we're starting to look at a lot more closely is, as I've mentioned, as it happens with the fund structure, that with the fund structures and with the fund industry and with the financial sector, the use of these arrangements, which are flow through from a Brazilian perspective, was very, if you will, tailored for certain specific fact patterns, such as those, fund type investors, institutional investors. We're starting to think about whether we shouldn't amplify that and consider that across the board for more different industries, either, the setting up of funds or the setting up of partnerships, which are very commonly used also in the fund industry and in certain sectors, in certain segments. So partnership modeling also from a Brazilian perspective, alongside financing and refinancing, maybe refinancing through a partnership distributions out of Brazil are taxed at 15%. We don't have a partnership per se, but we have contractual arrangements that resemble partnerships. And partnerships could end up with, let's say, an interest or a stake in business profits attributed to a non-resident, which might not be subject to the corporate tax. So you could end up having a situation of having effectively connected income through a Brazilian partnership that is subject to a 15% withholding tax and not to the 34 or 40 or 45 plus 10. So alongside with the financing ideas or strategies, we're thinking about also fund and partnership type planning. But back to you, Doug.
Yeah, so maybe changing gears a bit, Romero. Many taxpayers are, I mean, obviously, we are in an unprecedented environment from a geopolitical and macroeconomic environment. Tariffs are creating a lot of uncertainty for taxpayers, issue with supply chains, some of those related to tariffs, other related to other geopolitical issues. AI is transforming how companies do business, not just in the technology industry, but in all types of sectors. We're just seeing a lot, and that other companies are also looking at alternative revenue forms, from a buy-sell type model to service type models. So how does this potential change, along with the withholding taxes and all the other changes that we're seeing with taxpayers that are driving and potentially changing their transfer pricing models, their value chains, how do those relate, and what advice do you have for taxpayers as they are looking at holistically their global tax, legal, and economic structures?
Oh, Doug, I mean, never before was this so critical for the world, and I'll say, but for Brazil. And again, so critical in a way, so timely. What any multinational doing business in Brazil that managed to stay in business in Brazil has always done was to really think about value chain and business modeling for Brazil in a way that takes into account all the different taxes that we have. So it has to be a holistic business, supply chain, value chain, tax structure, financial design for a Brazilian operation to be functional and to be competitive. Locally, this has always been the case, but transfer pricing has always been a problem, right? So before Brazil aligned with the OECD guidelines of 2022, it was extremely difficult to make, if you will, a global business model fit Brazil, or make Brazil fit into a global business model. Since 23, 24, with the alignment that we have to the transfer pricing rules, we have evolved quite a bit in adapting global structures and global value chain models for Brazil, because now there's this point of convergence there. We can use Brazilian law and the delineation of transactions, which is very well regulated, let's say, in the Brazilian statute, and the definition of what transactions are and are not, are very, very usefully crafted in the Brazilian statute in transfer pricing. We're using that also to bridge into tariff, customs, withholding, remittance planning. So basically, with this new increased corporate tax rate, this becomes even more critical. I'll say that looking into intellectual property, IP type planning and structures, the broadest definition of intangibles that Brazil now uses in transfer pricing can come in handy here for cross-border fees or cross-border structures to be designed. I do think that, again, for FDI not to decrease in Brazil, for the adverse effect that we're seeing from this sunk cost to hit less severely multinationals that do business here, there's a fiduciary duty now. There's an obligation to revisit how these business models and how this value chain is structured for Brazil, and perhaps to really consider changing and transforming value chains in a way that might be more sophisticated, more difficult, let's say, but that now the equation, given the high tax, might make it make sense. So with that, let me just go very quickly through the questions we got from the audience. I think that we responded to pretty much all of them, but there's just one here that I want to pick up and just do a quick round of also, final words from our group. But there's a couple of questions here about treaties. I mean, will this mean that Brazil might be renegotiating its treaties? Brazil has just signed the MLI, is now part of the group. What does that mean? And I'll go even further and say, what does that mean with respect to the treaties that we have not even started negotiating for real again such as a treaty with the US and with Germany, reminding also viewers that we do have most favored nation clauses in quite a few treaties that Brazil has currently in place. So if we do reduce withholding rates in new treaties, that will have, you know, this rippling effect to quite a few other treaties. But I do believe that now that Brazil has something to give, the 10%, there's something to give up, where the US has a 30% FIDAP rate. Brazil does have a high corporate tax, but has this 10% withholding tax. The nudge, the final nudge here that is necessary is for Brazil to revisit its position on technical services. So Brazil is pushing the UN forward on 12AA and on, you know, having the broadest possible base on services type remittances. Brazil, in my view, will not be able to negotiate a treaty with the US or to renegotiate a treaty with Germany, and will, you know, if it does not change that position and comes a bit closer to the OECD in that regard. And without new treaties that will, if you will, move the needle, because that's what definitely the US and Germany would try to get, would be a reduction of 5% or a 0% on, you know, dividend withholding. But that's negotiation will not even start, in my view, without OECD or US model consistent Article 12. So just final words with a quick thank you again to all my panelists. Final words here from Doug, Arne, and Shin on treaty prospects.
You know, listen, I don't have a lot to add on the U.S. Brazil treaty. I think you articulated it well, Ramiro. Maybe sort of my closing comments for the participants of the webcast is it's November 24th, right? And you know, my suggestion, and I think I'm probably stealing the thunder from both Arne and Shin, is that if dividends need to be declared, and given the risk of a potential declaration without an actual cash distribution, if feasible, and to the extent that there is cash in the Brazilian entity, try to do what you can to be able to get that cash out before the December 31st deadline. For the U.S., for any U.S. participants on this call, so for any U.S. investors, I think that, you know, modeling, making sure that your stakeholders understand that the cost of investment in Brazil, to the extent that is intended, that cash will be coming out to those investors, that cost has increased and that ROI is reducing. And these are obviously very turbulent times. With Pillar 2, with all of the changes that we're seeing around the world. So continuing to make sure that you educate your fellow stakeholders to understand how that ROI could change as a result of this particular tax change is very important.
Yeah, Doug, now that you stole my thunder, I'll try what I can say, but it's another topic. No, I mean, I can only reiterate first what's the concrete first steps also for any kind of European or German investors. So I'll just not going to focus on that. But remember, I'll still try to answer your question. I think the situation a couple of years ago, you described when we decided to terminate the treaty, it's not being seen as, say, the brightest moment in German treaty policies. I would put it like that. So I think in principle, I would say we're hearing more and more that there is some kind of openness to open negotiations as well. I mean, you rightfully indicated that, of course, the topics you laid out still have to be talked about. But I think I would personally be a little bit more positive that at least from a German side, there would be some willingness to talk. Now, looking also from a macro perspective, I think there is, let's say, a lot of requests which we hear for some time by German industries to basically maybe have a look at that, and also, you know, trying to encourage outbound investments. But so it's going to be interesting to what extent that might give a little bit more kind of a push that those negotiations will open up and will be hopefully concluded successfully. We'll see.
Thank you, Arne. Shin.
Very quickly, so there is this juxtaposition between the treaty, which is a relatively older one, which does allow for this withholding tax, and then the foreign dividend exemption rules, which were passed more recently, which does not provide for credibility, whereby the exemption regime applies. So thereby there is a tax cost, potential tax cost in the case of Japanese multinationals with Brazilian subsidiaries. So something to look into and consider going forward.
Yeah, thanks, Steen. And again, thanks everyone. In closing, clearly there's immediate, urgent year-end action that we're recommending absolutely all of our multinational clients with investments in Brazil to take, which is if you have, again, in your local statutory books, don't be, don't rely upon your US GAAP, look at your local statutory books to the extent that there's any and all retained earnings through November 2025, it makes absolute sense to declare. To the extent you have cash, as Doug said, declare and pay, so you don't even have to think about any local risk. To the extent that you don't have enough cash to pay out all the dividends, that's fine. Still declare the total amount of retained earnings to the extent is there, and figure out when to pay, how to pay, whether to refinance, whether to put in a note, what structure you will want to have going forward in terms of your capital and your debt, and then think more broadly of value chain. So with that, I'll bring our webcast to a close. I really wanted to, from a true heartfelt, say thank you to my partners and friends and colleagues here. Special thanks also to Arne to be sitting at Vienna University. It makes it even more special for me to have you here. But Shin, not to put you down, I'll see you in the Silicon Valley in a few months' time. We have a lot to do there. And Doug, hope to see you in Brazil soon for our annual seminar. So thanks, everyone. Thanks to all the viewers. Have a great day or evening.